January 14, 2026. While the mainstream media spent the morning obsessing over celebrity scandals and political bickering in Washington, a silent, lethal strike was delivered to the heart of the Western financial system. It didn't happen with a missile or a cyber attack. It happened in the quiet, sterile trading rooms of the London Bullion Market Association and on the digital ledgers of the COMEX. As of this moment, we are no longer in a bull market. We are in a state of financial siege. 2 days ago, on January 12, 2026, Reuters broke a story that should have sent every person on Earth running to their local coin shop. Gold and silver didn't just rise. They notched record highs in a vertical move that defied every algorithmic prediction on Wall Street. Gold smashed through the psychological barrier of $4,500, but that was just the smoke. The fire, the real white-hot destruction, is happening in the silver market. The headline from Reuters was polite. Gold-silver notch record highs on safe haven demand, Fed rate cut bets. But if you know how to read between the lines, if you understand the language of those who actually move the world's capital, that headline translates to, the exit doors are locked, the building is on fire, and the global elites are the only ones with a key to the roof. Why is the most manipulated, suppressed, and undervalued metal in human history suddenly behaving like a penny stock on steroids? Because the great silver trap has finally been sprung. The Federal Reserve, trapped between a collapsing banking system and runaway inflation, has signaled a desperate pivot to rate cuts. But in doing so, they've handed China and Russia the perfect weapon to deconstruct the US dollar. Tonight, we aren't just looking at a price chart. We are conducting a forensic investigation into the end of the paper age. This is the moment the physical reality of the world finally breaks the digital illusion of the banks. The era of cheap, abundant silver is dead. The era of the American financial hegemony is on life support. This is not a drill. This is the funeral of the petrodollar, choreographed by Beijing and executed with the very metal that sits in your smartphone, your electric car, and your missile guidance systems. Let's reconstruct the crime scene using the facts provided by Reuters and the internal data leaking out of the East. On January 12, 2026, a perfect storm hit the commodities sector. First, the Federal Reserve. For the past 2 years, the Fed has tried to play the tough guy, keeping interest rates high to fight the inflation they created. But by late 2025, the cracks became canyons. The U.S. regional banking sector began to bleed out, unable to sustain the weight of high interest rates on their devalued bond portfolios. The Fed had a choice: let the banks fail or destroy the dollar. They chose the latter. The market began betting heavily on immediate, aggressive rate cuts for the first quarter of 2026. Second, the safe haven surge. When the central banks pivot in a high inflation environment, those in the know flee from yieldless currency into hard assets. Reuters noted that this demand was particularly explosive in India and China. In Mumbai, the premium for physical silver bars hit an unthinkable 15% over the London spot price. People weren't just buying silver, they were hoarding it as if their lives depended on it. Third, and most importantly, the geopolitical counterstrike. While the U.S. was busy celebrating the new year, Beijing quietly implemented the Strategic Mineral Security Act on January 1, 2026. This act essentially placed a chokehold on the export of refined silver and silver-based components, since China controls over 50% of the world's silver refining capacity. They didn't just raise the price. They removed the supply. By the time the markets opened on Monday, January 12, there was no liquidity left. The massive, hidden buy orders from sovereign wealth funds had already sucked the vaults dry. What we saw was a liquidity squeeze of biblical proportions. Silver didn't just go up, it gapped up, leaving short sellers, hedge funds, and bullion banks in a state of absolute panic. To understand why this is happening, we have to look at the short squeeze mechanics. For decades, the price of silver has been a fiction. It has been suppressed by a paper-to-physical ratio that, at times, exceeded 400 to 1. This means for every 1 ounce of real, physical silver in a vault, banks sold 400 ounces of digital silver to investors. It worked as long as nobody asked for their metal. But in early 2026, the world asked for its metal, the Chinese silver bullet strategy. China is playing a game of 4D chess while the West is playing checkers. For years, the U.S. has used the dollar and the SWIFT system as a weapon, sanctioning anyone who didn't fall in line. Beijing realized that the U.S. Achilles heel isn't its military, it's its total dependence on foreign supply chains for the green revolution. Every electric vehicle requires roughly 1 ounce of silver. Every solar panel, every 5G tower, every sophisticated missile guidance system requires silver. By banning the export of refined silver, China has effectively de-industrialized the U.S. green energy transition overnight. They have turned silver from a commodity into a geopolitical hostage. Think about the irony. The U.S. government wants net zero by 2030, but to get to net zero, you need silver. And to get silver, you now have to go through Beijing, who is only accepting payment in gold yuan or specialized hard asset trade units. The Reuters report mentions safe haven demand. But what they aren't telling you is that this is a resource war. The Fed's suicide mission. Now, let's look at the Fed. Jerome Powell is in a checkmate position. If he keeps rates high, the U.S. government can't afford the interest on its $35 trillion debt, and the banks collapse. If he cuts rates, as the Reuters report suggests the market expects, the dollar becomes a hot potato. When interest rates drop, the opportunity cost of holding silver disappears. In a world where the dollar is losing 10–15% of its purchasing power annually, a 0% yield on silver is infinitely better than a 4% yield on a dying currency. The institutional titans, the sovereign wealth funds of Norway, the UAE, and Singapore, have realized this. They are dumping their U.S. treasuries and buying anything that can't be printed. What we are seeing is a death spiral for the dollar. The more the Fed cuts, the higher silver goes. The higher silver goes, the more expensive it becomes for the U.S. to build the technology of the future. The more expensive tech becomes, the more inflation rises. It's a loop that only ends one way, with the total reset of the monetary system. The short panic of the bullion banks. We also need to discuss the commercial shorts. Banks like JP Morgan and HSBC have historically held massive short positions on silver to manage the price. In 2025, they were caught off guard by the sheer volume of Eastern demand. On January 12th, as the price surged to record highs, these banks faced margin calls in the billions. To cover their losses, they were forced to buy silver back at any price, which only pushed the price higher. This is the liquidity squeeze in action. We are witnessing the largest transfer of wealth in history, as the paper wealth of the West is liquidated to pay for the physical assets of the East. The most dangerous part of this story isn't the price on a screen, it's the physical deficit. For 5 years, the world has used more silver than it has mined. We have been living off the dregs of old stockpiles, but those stockpiles are gone. In the West, we treated silver like a byproduct of lead and zinc mining. In the East, they treated it like strategic fuel. As we move deeper into 2026, we are seeing force majeure events. Mining companies in Mexico and Peru are reportedly being encouraged by Chinese-backed interests to slow-walk deliveries to Western exchanges. If you are an American manufacturer, say an aerospace company building satellites, you are now facing a stockout scenario. This is where the thriller becomes reality. Imagine a world where Boeing or Lockheed Martin cannot fulfill a defense contract because they cannot source 500 pounds of high-grade silver. Imagine a world where Apple has to delay the next iPhone not because of a chip shortage, but because the conductive paste used in the circuitry is being rationed by the Chinese government. This is resource nationalism at its peak. The Reuters report touched on the safe haven aspect, but the industrial panic is what will drive silver to $100 and beyond. We are no longer debating if silver is undervalued. We are witnessing the market frantically trying to price in the extinction of available supply. The massive technology firms of Silicon Valley are now in a panic. For years, they ignored the commodity markets, assuming the supply chain would always be there. Now they are realizing that the cloud is built on a foundation of silver, and that foundation is cracking. We are hearing reports of tech giants attempting to buy entire silver mines in Nevada and Idaho just to secure their 2027 production lines. But it's too little, too late. The architects of this crisis, the ones who controlled the supply in the East, saw this coming years ago. If you look at the volume of the silver trades on January 12th, you see a very specific pattern. It wasn't retail fear, it was systematic large block purchasing. These are orders placed by entities that don't care about the price, they care about the delivery. Since December 2025, the registered silver stocks, the metal actually available for delivery on the COMEX, have dropped to levels not seen since the 1990s. We are days, perhaps weeks, away from a default into cash. This is the nightmare scenario for the Western financial system. It's when the exchange tells a buyer, "We know you bought silver, but we don't have it. Here is some paper money instead." But when the paper money is losing value every hour, no one wants the cash, they want the metal. When the COMEX defaults into cash, the price discovery mechanism of the West is dead. The price will then be set by the Shanghai Gold Exchange, and they aren't interested in helping the US dollar survive. The global financial architects, the ones who manage the world's largest pension funds and insurance pools, are now realizing that the paper silver they have on their balance sheets is worthless. They are all rushing for the same small exit at the same time. This is why the Reuters report mentioned record highs for both gold and silver. They are moving in tandem because they are both parts of the same life raft. But silver is different. Gold is mostly hoarded in vaults. Silver is consumed. Once it's in a solar panel or a cruise missile, it's gone. You can just recirculate it. The industrial demand is a one-way street, and the street just hit a dead end. The US Treasury is now in a state of emergency. If they can't stabilize the silver price, they can't stabilize the technology sector. If they can't stabilize the tech sector, the stock market collapses. If the stock market collapses, the US government loses its tax base. It's a house of cards, and the wind from the east is blowing harder than ever. We cannot talk about the Reuters report without talking about the BRICS Plus alliance. For the last 18 months, Russia and China have been working on a unit of trade, a currency backed 40% by gold and 60% by a basket of commodities, including silver. By driving the price of silver to record highs, they are effectively revaluing their new currency while devaluing the US dollar. Every dollar that the Fed prints to save the US banks makes the BRICS currency stronger by comparison. It's a masterclass in economic warfare. Russia, for its part, has recently added silver to its state reserves for the first time in decades. They know what's coming. They know that in a world of digital sanctions, the only thing that matters is what you can physically hold and what you can physically trade. The West thought they could win with software and finance. The East is winning with hardware and elements. The Reuters report mentions Fed rate cut bets, but what it doesn't mention is that the Fed is no longer the most important bank in the world. The People's Bank of China and the Central Bank of Russia are now the ones setting the tempo. They are the ones who decided that January 2026 would be the month the West realized it was bankrupt. While the Reuters article focuses on general safe haven demand, we need to look at the insiders. These are the individuals and entities that have spent the last decade preparing for this exact moment. We aren't talking about small-time investors. We are talking about the family offices of the ultra-wealthy, the sovereign funds of resource-rich nations, and the massive industrial conglomerates that need silver to survive. They aren't buying 10 ounces or 100 ounces. They are buying by the ton. They are using what are known as dark pools to acquire physical metal without alerting the public. They know that once the man on the street realizes what's happening, the price will already be in the hundreds. By the time you see the silver record high headline on your phone, the insiders have already filled their vaults. The institutional giants have abandoned the 60/40ths portfolio of stocks and bonds. They are moving toward a hard asset model. They are buying land, they are buying energy, and they are buying silver. They are preparing for a world where the US dollar is just another failed fiat currency in the dustbin of history. So what is the climax of this story? The record highs of January 12, 2026 were not the peak, they were the breakout. We have spent 40 years in a bull market for silver, and we are now entering the scream phase. The Reuters report gave us the what. I have tried to give you the why. The Fed is trapped and will sacrifice the dollar to save the banks. China and Russia have weaponized silver to cripple Western industry and back their own new currency. The paper silver market is being exposed as a massive, multi-decade fraud. The industrial world is facing a stockout that will halt the green energy transition and military production. The global elites have already left the building. They moved into gold at $2,000 and they moved into silver at $25. Now, as the price rockets toward triple digits, the retail crowd is finally waking up. But by the time the average person realizes they need silver, it won't be expensive, it will be unavailable. The final warning. Do not be distracted by the daily dips or the volatility. The banks will use every trick in the book, fake sell-offs, media hit pieces, and margin hikes to get you to drop your physical metal. They need your silver to cover their shorts. They need your real assets to pay for their fake debts. The question you have to ask yourself tonight is simple. In a world of digital lies and printed trillions, what is the weight of the truth in your hand? We are moving into a bipolar financial world. The West has the printing presses. The East has the metals. History is very clear about which side wins that battle every single time. Keep your eyes on the volume. Watch the COMEX delivery reports, and most importantly, watch what the big players do, not what they say. They are telling you exactly where the ship is headed. We don't just report the news, we investigate the forces that create it. Stay sharp, stay liquid, and stay out of the trap. What's your move? Are you holding the metal or are you holding the bag? Leave a comment below. Let's discuss the silver trap. And if you want to follow the real flow of capital through this chaos, make sure you're subscribed. This is a financial thriller, and we are only in the second act. Stop everything you are doing. If you are watching this, you are witnessing the definitive end of a financial era. While the mainstream media was busy obsessing over political theater in Washington and distracting the masses with bread and circuses, the tectonic plates of the global markets just shifted in a way we haven't seen in over a century. On January 7, 2026, the impossible happened. A financial event so profound occurred that it marks the violent birth of a new monetary order. Silver, the element argentum. Number 47 on the periodic table, a metal mocked for decades as the poor man's gold, just flipped NVIDIA in total market capitalization. Let that sink into your bones. NVIDIA, the poster child of the artificial intelligence revolution, the darling of Wall Street, and the supposed god of the 21st century tech boom, was just run over by a freight train of physical reality. For 15 years, we have lived in the everything bubble. We were told that data was the new oil, that AI was the new religion, and that physical assets were merely pet rocks left over from a primitive past. But as of this morning, that narrative didn't just crack, it shattered into a million pieces. The smart money, the sovereign wealth funds, the central banks, and the billionaire family offices has officially pulled the plug on the digital illusion. The great rotation from pixels to atoms has begun. This is not a drill. It is a declaration of war between a debt-based paper system and a resource-based physical reality. Today, we dive into why the $80 silver you see on your screen is the biggest bargain in human history, and why the March delivery cycle is about to trigger a global financial force majeure. The catalyst for this earthquake began during the early hours of the Asian trading session. While New York was asleep, a massive wave of institutional buying flooded the markets, pushing silver's total market capitalization to a staggering $4.65 trillion. In one swift move, it eclipsed NVIDIA, reclaiming its throne as the second most significant asset class on Earth, trailing only gold. But the real story isn't just the price, it's the systemic failure occurring in the plumbing of the market. We are currently witnessing a run on the bank in the physical silver market. To understand why this is a crisis, you have to understand the COMEX calendar. Historically, January is a non-delivery month, a ghost town where trading volume is low and almost no one asks for physical. Metal traders usually roll their paper contracts forward to March. However, 2026 has broken the script. In the first 72 hours of January, 4,697 contracts stood for immediate physical delivery. That represents 23.5 million ounces of silver being drained from the vaults in a month where nothing was supposed to happen. This is the equivalent of a massive line forming outside an insolvent bank at 3 a.m. The data shows that J.P. Morgan, the custodian of the world's largest silver hoard, was forced to issue over 60 delivery notices in a single day. They are raiding their own strategic stockpiles just to keep the lights on and prevent a total market default. The paper wall that suppressed silver for 50 years has been breached, and the smart money is no longer asking for cash settlements. They are demanding the bars. The geopolitical squeeze, silver as a weapon of war. Why is silver suddenly the most hunted asset on the planet? It is because silver is the Achilles heel of the modern Western economy. We are currently in the midst of a great resource war between the United States and the China-led BRICS Plus. bloc. China has realized that they don't need to win a hot war if they can win the commodity war. Silver is the indispensable oxygen of the future. You cannot have an AI revolution without silver. You cannot have a green energy transition without silver. You cannot build a modern military-industrial complex without silver. By hoarding physical silver and draining Western vaults, China is effectively cornering the market on the 21st century. If the West loses access to physical silver, the Green New Deal dies, the AI data centers stop expanding, and the defense industry faces a catastrophic bottleneck. B. The forensic math. The great inflation lie. The mainstream media will tell you that silver at $80 is expensive. This is a mathematical deception designed to scare retail investors out of their positions. To find the truth, we must look at the inflation-adjusted reality. In 1980, silver hit a peak of $50, but what was $50 worth in 1980? You could buy a decent house for $60,000 and a new car for $5,000. Today, those same assets cost 10 times as much. If we use the government's own CPI, Consumer Price Index, the 1980 high of $50 is equivalent to $170 today. If we use shadow stats methodology, calculating inflation the way it was done before the government changed the rules to hide the truth, that 1980 high is equivalent to over $400 an ounce. At $80, silver is the only asset in the world trading at a massive discount to its price from 46 years ago. Real estate is up 10x. Stocks are up 20x. But silver is still coiled like a spring, trading at less than half of its fair value. A move to $200 isn't a moonshot. It is simply a mean reversion to historical purchasing power. See the death of counterparty risk. The flipping of Nvidia represents a fundamental shift in what investors consider wealth. For 15 years, wealth was a digital entry in a database. But as the U.S. national debt climbs by $1 trillion every 100 days, the counterparty risk of the paper system has become terminal. When you own Nvidia, you own a claim on a company that relies on the CEO's sanity, the power grid staying online, and the SEC's regulations. When you hold a physical ounce of silver, you own an atomic reality with zero counterparty risk. It does not require a central bank to print it, a CEO to manage it, or the internet to be functional. In a world of $36 trillion in debt, the only honest thing left is a bar of metal. D. The March deadline, a mathematical trap. The bullion banks and the shorts are currently trapped in a cage with a hungry tiger. They have sold hundreds of millions of ounces of paper silver that they do not physically possess. They assume they could always settle in cash or find metal in the open market. But the open market is broken. Premiums are skyrocketing, and the January anomaly has stripped the banks of their buffer. They are now heading into the massive March delivery cycle with an empty cupboard. If they try to buy silver to satisfy the March contracts, the price will go to $200 overnight. If they don't buy, they default. We are looking at the potential for force majeure, the point where the COMEX admits the vault is empty and tries to rug pull investors by offering devalued cash instead of the promised metal. We are no longer in a period of speculation. We are in a period of exodus. The flipping of Nvidia was the ultimate market signal. It was the moment the world realized that you cannot eat an algorithm, and you cannot build a future on debt alone. The great rotation is accelerating at the speed of light. Trillions of dollars of paper profits are trying to squeeze through a tiny exit door into the physical resource market. It is like trying to push the entire volume of the Hoover Dam through a garden hose in a single second. The pressure is explosive, and the walls of the financial system are starting to buckle. The bullion banks have less than 60 days to find metal that does not exist. They are frantically calling refineries and mines, but the supply has already been spoken for by the East. If you are waiting for a pullback to the old days of $20 or $30 silver, you are betting on a world that has already passed away. The air pocket between $80 and $200 is empty. Once the market realizes that JP Morgan is scraping the bottom of the barrel, the panic will go exponential. The masses will wake up. The fear of missing out, FOMO, will kick in, and the dealers will hang up the sold out sign. So, I leave you with one question. When the March deadline hits and the paper system finally decouples from reality, what will be in your vault? Will you be holding the pixels of the past overvalued tech stocks and devaluing dollars? Or will you be holding the atoms of the future? The script has been flipped. The silver age has begun. Secure your position now while the exit door is still ajar. This is the rotation of the century. Don't just watch it happen. Be part of it. There is a theory in chaos mathematics called the butterfly effect. It posits that a butterfly flapping its wings in Tokyo can cause a tornado in New York in the high-stakes world of global finance. This is no longer just a mathematical theory. It is a cold, hard mechanical certainty. While the mainstream media remains pathologically obsessed with the Federal Reserve's next move, the theater of the U.S. election cycle, or the latest geopolitical skirmish in Venezuela, they are blind to the single most dangerous chart in the history of modern finance. This chart has just shattered a 25-year trend, signaling the absolute end of the free money era. I am talking about the Japanese government bond yields, specifically the 30-year yield, which has just surged to a staggering 3.5%. To the average person, these are just boring numbers on a screen, but to the institutional plumbing of the world, this is a catastrophe. For 2 decades, Japan has acted as the global ATM, printing unlimited yen and keeping rates at zero. But today, that ATM is not just closed, it is demanding its money back. The yen bomb has detonated, and the timer just hit zero. To understand why 3.5% represents a global disaster, we must pull back the curtain on the game Wall Street has been playing since 2001, known as the yen carry trade. Imagine you are a veteran hedge fund manager in New York. You want to buy Nvidia, Bitcoin, or US Treasuries, but you don't want to use your own capital. You want leverage. You look for the cheapest loan on the planet, and you find it in Japan, where the Bank of Japan has maintained interest rates at zero or even negative for years. You borrow 1 billion yen at virtually no cost, convert that yen into US dollars, and buy assets yielding 5% or 10%. You pocket the difference as pure profit. This free money engine has pumped trillions of dollars into Western markets, acting as the primary liquidity driver for the massive asset bubbles we see today. However, this entire mechanism relies on one fatal assumption, that Japanese rates will stay low forever. That assumption has just evaporated. The Bank of Japan has officially lost control as inflation forces them to tighten their grip. When the 10-year yield crossed 2.13% and the 30-year hit 3.5%, the golden number was breached. Japan is a nation of savers, with massive pension funds and life insurers that have been forced to invest offshore for decades because they couldn't find yield at home. They are currently the largest foreign holders of U.S. debt, owning over $1.2 trillion in treasuries, but now they can get 3.5% risk-free at home in Tokyo without any currency risk. The great repatriation has begun. Japanese investors are selling their U.S. bonds and pulling their capital back to Tokyo. This creates a massive liquidity vacuum in the heart of the Western financial system. When the largest buyer in the room leaves, the floor falls out, and that is exactly what we are witnessing right now. This is not merely a Japanese crisis. It is a global margin call that is about to ripple through every asset class. When the yen strengthens and Japanese rates rise, those trillion-dollar carry trades become toxic. Hedge funds that are over-leveraged must sell their winners, their U.S. tech stocks and their crypto, just to pay back the yen they borrowed. This creates a wave of mechanical selling pressure that has absolutely nothing to do with economic fundamentals or corporate earnings. We are entering a deleveraging event that will expose the shadow casino of the global banking system. The notional value of global derivatives tied to interest rates is estimated to be near $1 quadrillion. Most of these are bets that rates would stay stable. As Japan pushes global yields higher, these derivative bets are blowing up, creating a credit contagion that will force the Federal Reserve into a desperate corner. The United States government is currently running a deficit of $2 trillion a year, requiring a constant stream of foreign buyers to keep the lights on. But with China selling and Japan repatriating, the U.S. Treasury market is facing a terminal collapse. To prevent interest rates from spiking to 7% or 8%, which would make the U.S. government insolvent, the Federal Reserve will be forced to implement yield curve control. They will have to become the buyer of last resort, printing infinite new dollars to buy the old bonds that Japan is dumping. This is the ultimate surrender. It means the central bank has prioritized the solvency of the government over the value of the currency. Once the market realizes that the supply of dollars is going vertical to save the bond market, faith in fiat currency will vanish. This is the precise moment when capital flees from the leveraged paper economy and into the real economy of hard assets. Silver is the primary beneficiary of this systemic shift because it sits at the intersection of monetary history and industrial utility. Unlike a treasury bond or a bank deposit, silver has no counterparty risk and cannot be diluted by a central bank printer. In the initial phase of this liquidity shock, everything gets sold, and we may see silver prices dip as traders cover their margin calls. But once the smoke clears, the rush for safety will be unprecedented. We are looking at a dual driver for silver: the Fed's desperate printing to absorb Japanese selling, and a surge in industrial demand from a manufacturing-heavy Japan that now has a stronger currency to buy raw materials. This is not a speculative rally, it is a monetary flight to quality. We are repeating the cycle of the 1970s, where bonds crashed and precious metals went to the moon. But this time, the debt levels are 10 times higher and the exit door is much smaller. The yen bomb is the pin that has finally popped the global debt bubble, marking the definitive end of the era of cheap money. We have moved past the point of speculation and into the era of a violent global repricing. History gives us a clear roadmap for what happens next. In every major crisis, from 2008 to 2020, the response has always been the same: massive liquidity injections. When the Fed eventually surrenders to yield curve control to save the banks, silver will not just rise, it will explode. We have established conservative price targets based on the gold-to-silver ratio compression. At a $4,500 gold price, a return to the historical ratio of 41 puts silver at $112. In a true panic, similar to the 1980s, that ratio could collapse to 15:1, sending silver toward $300. However, you must be prepared for the journey. The path from $70 to $300 will not be a straight line. It will be a jagged, violent trajectory filled with shakeouts designed to scare you out of your position. The smart money wants your physical metal so they can cover their paper shorts as the system breaks. Do not let the volatility of the carry trade unwind steal your future. If you own the metal and avoid leverage, you can ride out the storm while the fiat system burns. The yen is moving, the bonds are breaking, and silver is the next domino to fall. Hold fast, because the great repricing has only just begun. The global ATM is out of order, and the only currency that will matter is the one you can